I think that we're in an unprecedented investment bubble, and I'm actually worried. And I say that this is unprecedented because we've never ever seen an investing environment where there were so many different sectors at all-time highs at the exact same time. It's frightening. And many stock markets are near an all-time high. Input prices like lumber and the real estate sectors are at all-time highs in many markets. Cryptocurrencies until recently were at an all-time high. And even the collectibles market, man. The collectibles market is at an all-time high, meaning baseball cards, hockey cards, basketball cards, and even NFTs. And this here is a Wayne Gretzky rookie card. Okay, a smaller version of this card was sold for close to $4 million. It's unbelievable. And one of my first side businesses when I was a kid was I enlarged cards and I sold them for $10 each. I didn't know that was against the law back then from a copyright perspective. But anyway, that's what I did. And I used to stick these in my wall too. It's kind of fun. I think I was like 11 years old or so. Yeah. All right. So why are the prices of so many investments at all-time highs? What's going on? Well, it's because desperate times call for desperate measures. And governments are very worried, rightly so, about the impact of COVID. That what they decided to do was to keep interest rates close to zero. And what happens is when interest rates are very, very low, people don't keep money in the bank because cash is trash and rates are too low. In fact, over the past year, the United States government has printed about 30% more money than existed in 2019. And it dilutes all of us. It's not fair, but that's okay because many of us are making money in different investments now. So what happens is when interest rates are zero, it encourages people to invest elsewhere, like stocks, real estate, etc. Now, the economic impacts of COVID are unknown. So governments have kept rates low for much, much longer than they usually do, which has led to many bubbles. And prices are increasing all around us. And this is not sustainable. So I think what's going to happen is governments are going to soon start raising rates in order to stop prices from rising. And when rates go up, it's harder for us to get loans to invest, and people leave more money in the bank to make the higher interest rate when rates rise. Now, an extreme example of when rates were as high as close to 20% was around 1980, when the United States manager of money, meaning the Federal Reserve, United States manager of money, the Federal Reserve chairperson, Paul Volcker, raised rates to close to 20% in order to fight inflation. It was a scary time in 1980. I remember my dad in Canada, he had a big mortgage on the house, and he was just starting his company as well. And in Canada, you can't write off the interest on your mortgage. So we had a 20% mortgage as a kid. And my dad's awesome dealing with pressure. He's unemotional, which is awesome. So we got in the middle there Paul Volcker, and so he was, God bless him, he just passed away, the manager of the Store of Money in America. And then on the left there you got Alan Greenspan in the glasses, who was the Federal Reserve chairperson up until I think the 2005 or 6. And then you got Ben Bernanke, who's my hero, on the other side there. Ben Bernanke was the Federal Reserve chairperson in 2008 when we were within 24 hours of bank machines not working. And the reason I say he's my hero, and it's controversial, is because he did his PhD at Princeton University in depressionary economics. And had Bernanke not done his PhD at Princeton in depressionary economics, then he would not have pulled a lot of levers to fix the economy fast. And we could have gone into another Great Depression in 2008. Okay, so Volcker's in the middle. Times were tough in the early 80s. And just imagine having a mortgage near 20%. Now, what happened was in 1980, because rates were so high, investors did not buy stocks or real estate because they could make close to 20% by leaving their money in the banks. And as a result, hardly any companies were founded in 1980s. And it was devastating for the U.S. economy back then. Now, I don't think the United States government is going to raise rates that much in the near term. But Volcker, the Fed chairman, had to raise rates then and quickly to fight inflation. Prices were rising fast. In fact, what he did was he flew to Germany in 1980 to get advice from German economists. because Germany had brutal post-World War I inflation, and the Deutschmark became basically worthless. So people actually, this is fascinating when it comes to the Deutschmark. People even use wheelbarrows to bring German money to markets to buy a loaf of bread after World War I. And what also happened was kids played with money because it was worthless. Now, the result of rising interest rates in the 1980s, early 80s, decimated the economy in the near term, but it was the right decision. You have to fight inflation, otherwise you don't have an economy. So the bottom line is that I believe that rates are going up soon in order for the government to fight inflation, and I'm currently not a net buyer of investments at this point.